Welcome to our educational video on profitability evaluation. To start, let's define what profitability really means. Profitability is the ability of a business or project to generate earnings compared to its expenses and other relevant costs, over a specific period. It's a crucial metric for measuring success and sustainability. You might be wondering why evaluating profitability is so important. Without a clear understanding of profitability, companies can struggle to make informed decisions that impact growth and sustainability. By constantly evaluating profitability, businesses can identify areas for improvement, optimize performance, and achieve long-term success. In this video, we'll take you on a journey through the evolution of profitability evaluation methods, from their historical origins to the advanced techniques we use today. You'll get a comprehensive overview of various approaches and learn about key metrics such as return on investment, ROI, net present value, NPV, and internal rate of return, IRR. As we move forward, you'll discover how profitability evaluation has developed over time and what the future holds for this essential financial practice. Let's dive in and start uncovering the fascinating world of profitability evaluation together. Let's begin our journey into profitability evaluation by delving into its historical context. In the early days of commerce, profitability evaluation was far from the precise science we know today. Pioneers in financial analysis employed rudimentary methods to estimate profitability. These methods, although basic, laid the crucial groundwork for the sophisticated tools we use now. Historical records show that the earliest attempts to evaluate profitability were often fraught with challenges due to limited data and primitive accounting techniques. However, these initial hurdles pushed early analysts to innovate and refine their approaches. The historical significance of these early methods cannot be overstated. They were the stepping stones leading to the monumental strides we see in modern financial analysis. Understanding these origins provides us with valuable insights into the evolution and refinement of profitability evaluation over centuries. This foundation is pivotal not only for appreciating the progress made but also for applying these learnings to contemporary practices. Let's take a closer look at how these early methods shaped the future of financial analysis. Over the years, profitability evaluation methods have undergone significant transformations. Initially rooted in basic calculations, these methods have continually evolved, adapting to the increasing complexities of modern business environments. Let's take a journey through this evolution, exploring key milestones and the influential figures who propelled these advancements. From early pioneers who introduced foundational concepts, to contemporary experts who refined and expanded these ideas, each era introduced crucial improvements that shaped current practices. As we delve into these developments, we'll see how incremental enhancements and groundbreaking innovations alike contributed to more accurate and robust profitability assessments. This continuous evolution not only reflects the growth of financial analysis as a discipline but also underscores the relentless pursuit of precision and reliability in profitability evaluation. As we move forward, you'll discover how these historical advancements laid the groundwork for the sophisticated methods we use today, and how they continue to inform and improve our financial decision-making processes. Financial analysis plays a crucial role in evaluating the profitability of a business or project. At its core, financial analysis involves examining financial data to assess performance and make informed decisions. By delving into key financial statements, like balance sheets, income statements, and cash flow statements, analysts can gauge the fiscal health of an entity. Profitability evaluation relies heavily on this analysis to identify trends, pinpoint strengths, and highlight areas for improvement. Now, let's break down some basic concepts. First, we have profitability ratios, which measure the efficiency with which a company generates profit. Common ratios include gross profit margin, net profit margin, and return on assets. Each offers a unique lens on financial performance. Next, the liquidity ratios determine a company's ability to meet short-term obligations, adding another layer to profitability analysis. Understanding these fundamental principles of financial analysis helps in accurate profitability evaluation, guiding strategic decisions and fostering sustainable growth. As we move forward, you'll find how different methods and approaches weave into the fabric of modern financial analysis. Together, we will explore how these concepts have evolved over time to shape the sophisticated tools used today. In today's fast-paced business environment, the techniques used for evaluating profitability have evolved dramatically. Modern methods leverage cutting-edge technologies and innovative approaches that go beyond traditional financial analysis. From advanced software to sophisticated algorithms, these tools help us paint a clearer picture of a company's financial health. Take, for instance, the application of big data and machine learning. These technologies allow for deeper insights and more accurate forecasting, making it possible to predict profitability with higher precision. Let's delve into a few real-world case studies. Companies like Tesla and Amazon have revolutionized their profitability evaluations by integrating advanced analytics into their financial strategies. These case studies highlight the practical benefits and provide valuable lessons on the implementation of modern methods. As we progress, you'll discover more nuanced techniques and see how these innovations are shaping the future of profitability evaluation. Stay with us as we continue to explore these fascinating advancements and uncover even more powerful tools in the next segment. Ratio analysis is a fundamental method used to evaluate a company's profitability. In essence, it's the application of various financial ratios to provide insight into different aspects of a business's performance. These ratios are calculated using data from financial statements, allowing analysts to gauge efficiency, liquidity, and profitability. Let's start with some common ratios. The gross profit margin measures the percentage of revenue left after subtracting the cost of goods sold, indicating the efficiency of production processes. The net profit margin goes a step further by factoring in all expenses, revealing the overall profitability of the company. Then there's the return on assets, ROA, which shows how effectively a company uses its assets to generate profit. Interpreting these ratios is crucial. A high gross profit margin suggests efficient production and pricing strategies, while a low net profit margin might indicate high operational costs. ROA helps compare profitability across companies of different sizes within the same industry. As we move forward, you'll see how these ratios form the backbone of financial decision-making, offering insights that can drive strategic planning and investment. Understanding these metrics isn't just about crunching numbers, it's about grasping the underlying health and potential of a business. Break-even analysis is an essential tool for determining when a business will start making a profit. At its core, break-even analysis helps identify the point at which total revenues equal total costs, effectively zeroing out any net loss. To calculate the break-even point, you divide the fixed costs by the difference between the unit's selling price and the variable cost per unit. This results in the number of units that need to be sold to cover all costs. Now, let's delve into its applications in evaluating profitability. Business owners and financial analysts often use break-even analysis to decide whether to launch a new product, enter new markets, or identify the sales volume needed to avoid losses. This analysis not only supports pricing strategy but also aids in financial planning and decision-making. Understanding the break-even point arms businesses with crucial insights, enabling better resource allocation and risk management. As we move forward, you'll discover additional profitability evaluation methods that leverage similar principles to provide a more comprehensive financial picture. Return on investment, or ROI, is a key metric in profitability evaluation. It measures the efficiency of an investment by comparing the returns to its cost. To calculate ROI, we use the formula, ROI equals the net profit divided by the cost of the investment, then multiplied by 100. For instance, if your investment earned a profit of $5,000 and cost $2,000, the ROI would be 250%. Understanding ROI helps businesses determine the feasibility and profitability of various projects or investments. It answers critical questions like, are we getting enough return for our expenditures? Is this project worth continuing? ROI is not just a number, it's a strategic tool that guides investment decisions and helps prioritize projects. As we move forward, you'll see how net present value, or NPV, accompanies ROI in evaluating profitability and how to interpret these crucial financial metrics. So, stay tuned, as next, we'll dive into the intricacies of NPV. Net present value, or NPV, is another important metric in profitability evaluation. It's a financial measure that helps us understand the value of future cash flows in today's terms. By discounting future income to its present value, we can gauge whether a project or investment is truly profitable. To calculate NPV, we start by estimating future cash flows. These are the predicted amounts of money a project will generate over time. Next, we choose an appropriate discount rate, reflecting the cost of capital or the required rate of return. Finally, we subtract the initial investment from the sum of the discounted cash flows. The formula might seem complex, but it's a powerful tool for decision-making. NPV is widely used in various fields to determine the feasibility of projects, from corporate finance to real estate. By quantifying the difference between expected gains and costs, NPV offers a clear metric for profitability. This method helps businesses make informed decisions, prioritize projects, and allocate resources efficiently. As we continue our exploration of profitability evaluation, we'll next delve into another vital concept, the internal rate of return, or IRR. Stay tuned as we unravel how this metric complements NPV in financial analysis. Internal rate of return, or IRR, is a crucial metric in profitability evaluation. It represents the discount rate that makes the net present value of all cash flows from a project equal to zero. Essentially, IRR helps determine the efficiency or potential profitability of an investment. To calculate IRR, we set the net present value equation to zero and solve for the discount rate. This involves computing several potential rates and iterating until we find the exact point where the NPV equals zero. It's more complex than simple arithmetic and often requires financial calculators or software for precise calculation. The importance of IRR lies in its ability to provide a clear percentage return expected on an investment, which enables comparisons across different projects and investments. Companies and investors heavily rely on IRR to make informed decisions, choosing projects with higher IRR values to ensure better returns relative to the cost of capital. As we dive further, let's explore other methods and metrics utilized in profitability evaluation, and see how they complement our understanding of IRR. Welcome to the comparative analysis segment. This powerful tool is pivotal in evaluating profitability by meticulously comparing different metrics. We'll start by defining what comparative analysis entails. Comparative analysis involves methodical comparisons across key financial metrics to uncover insights. It's like a financial detective, helping us link performance and profitability by examining variables such as revenue, expenses, and profit margins. There are various methods available for conducting comparative analysis. The most common approaches include time series analysis, which compares data across different time periods, and cross-sectional analysis, which evaluates data across different entities or segments within the same period. These methods allow us to benchmark performance against standards, competitors, or historical data. We can identify patterns, trends, and anomalies that might otherwise go unnoticed. By comparing current financial metrics with past performance or industry benchmarks, businesses can measure their profitability more precisely. This helps identify strengths to leverage and weaknesses to address. It provides a comprehensive view, aiding decisions that improve profit-generating strategies. As we look to the future, new trends and technologies are emerging in the field of profitability evaluation. We'll be diving into some of the most promising developments on the horizon. From advancements in data analytics to the growing influence of artificial intelligence, these innovations are set to transform how we evaluate profitability. Imagine utilizing machine learning to predict financial outcomes with unprecedented accuracy. Or leveraging big data to uncover hidden patterns and insights that can drive better decision-making. But it's not just about technology. Future challenges will also require us to rethink our approaches and methodologies. As global markets evolve, companies will need to adapt and innovate to stay ahead. There will be a greater emphasis on sustainability and social responsibility, impacting how profitability is measured. With these trends, we are ushering in a new era of profitability evaluation. It's an exciting time filled with opportunities for those ready to embrace change and lead the way. As we move forward, you'll see how these emerging trends and technologies will shape the future of our industry and redefine success. Let's look at a real-world case study where profitability evaluation was successfully implemented. This case epitomizes how modern methods can translate to tangible results. In this scenario, the company meticulously employed advanced evaluation techniques. They started with ratio analysis, leveraging key financial ratios to assess their overall financial health. Next, they applied break-even analysis to pinpoint the exact moment their business would start generating profit. Alongside, they utilized return on investment calculations to understand the long-term benefits of their investments. Net present value and internal rate of return metrics were used to measure the profitability of ongoing projects, ensuring that every financial decision was well-informed. Comparative analysis provided an additional layer of insight by benchmarking their performance against industry standards. The results were remarkable. They achieved a significant increase in profitability, demonstrating the power of systematic and methodical evaluation methods. This case study doesn't just highlight the steps taken but also serves as an inspiration and a model to mirror. Success in profitability evaluation is achievable when armed with the right tools and methods. As we move forward, you'll see how avoiding common pitfalls can further enhance these results. Profitability evaluation can be challenging. In this segment, we'll address common mistakes that often trip up even seasoned analysts. First, failing to account for all costs, including hidden ones, can skew results significantly. To avoid this, it's crucial to meticulously track and include every expenditure. Another common pitfall is overlooking the impact of time value of money on cash flows. This can lead to inflated profitability estimates. Ensure you're discounting future cash flows accurately. Misinterpreting financial ratios can also be misleading. It's vital to understand the context behind each ratio and compare them against industry benchmarks. Lastly, relying solely on one evaluation method can provide an incomplete picture. A multifaceted approach, incorporating various methods like NPV, ROI, and break-even analysis, offers a more comprehensive assessment. By being mindful of these issues and adhering to best practices, you can enhance the accuracy and reliability of your profitability evaluations. As we move forward to our conclusion and summary, we'll tie together all the key insights shared throughout this video to solidify your understanding and application of these concepts in real-world scenarios. In conclusion, we've journeyed through the diverse landscape of profitability evaluation. From historical methods to modern techniques, we've explored the foundations and advancements that shape today's financial analysis. We began by understanding the basic principles of profitability evaluation and its critical importance. We then delved into the evolution of these methods over time, highlighting the milestones and key figures who paved the way. This was followed by an introduction to financial analysis, setting the stage for our deeper dive into the modern approaches. We examined various evaluation methods, such as ratio analysis, break-even analysis, ROI, NPV, IRR, and comparative analysis, each serving as powerful tools in our financial toolkits. Alongside this, we looked into the future trends in profitability evaluation, emphasizing the continuous innovations that keep this field dynamic. Our real-world case study underscored the practical application of these methods, while our discussion on common pitfalls and best practices offered valuable insights to avoid costly mistakes. We hope this video has been insightful and encourages you to apply these principles in your own endeavors. Remember, effective profitability evaluation is key to making informed business decisions. Thank you for watching and best of luck in your financial analyses.